Okay, good morning, everyone. Let's call the meeting to order. Item number 2 on our agenda is to approve the minutes of the special meeting of July 15th, 2019.
Second.
I have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item 3 is the consent docket. One item. Second. I have a motion and a second on item 3. All in favor? Aye. All opposed? Motion carries. Item 4 is to ratify approvals. We have 2 items. I have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item 5 is to approve the claims docket. I have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item 6 is to approve the following applications for service retirement. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to receive a report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to the spouse. I have a motion and a second on item 7. All in favor? Aye. All opposed? Motion carries. Item 8 is to receive the report of death, approve continuation of pension to the spouse. I have a motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is to receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second on item 9. All in favor? Aye. All opposed? Motion carries. Item 10 is to receive report of death, authorize secretary to make necessary changes to conform on the following. Motion and a second on item 10. Bless you. All in favor? All opposed? Motion carries. Item 11, ratify approval of the request to terminate vested rights and receive a lump sum distribution of his or her employee contribution account. I have a motion and a second on item 11. All in favor? All opposed? Motion carries. Item number 12 is items for individual consideration. Item 12A is to conduct a retirement system experience study not to exceed $25,000. There's an item in the packet from Gabriel Roeder-Smith, Louise, outlining what the experience study will encompass. Any questions?
Yeah, I just was curious about factors for optional forms of payment. What is that?
Those are the actuarial calculations we use to determine the reduction for the when an employee takes the $30,000 lump sum benefit. So there's certain actuarial factors based upon life expectancy that they will evaluate also.
Thank you.
Very good question. Any other questions from the board? Hearing none, I'll entertain a motion on item 12A. I have a motion and a second on item 12A. All in favor? Aye. All opposed? Motion carries. Item 12B is the purchase of a laptop/tablet and required software package not to exceed $1,500 for retirement system staff. I have a motion and a second on item 12B. All in favor? Aye. All opposed? Motion carries. Item 12C, I'm not going to read the whole deal, but this is approve the retention agreement for securities class action litigation between the ERS and Labaton Sucaro LLP to engage said firm to provide professional legal services necessary to prosecute a securities class action case against Pivotal Software, Inc., and authorize Labaton to submit necessary pleadings and documents to initiate said class action and for ERS to be appointed as the lead or co-lead plaintiff. I had asked Renee when I first received the agenda. I knew we visited this item a couple years ago as to what the litmus test would be as far as us agreeing to be a lead plaintiff. She brought me up to speed, but honestly, I don't remember what she told me as to what the dollar limit was and all that, so. Wiley,
This is the first time a case has come up that meets the criteria you set forth in the policy you adopted a couple of years ago about being lead counsel. You didn't want to entertain everything that came across. So from that standpoint, it meets the criteria. The Pivotal Software is a company that we ultimately invested $155,000 into in stock purchases. And the gist of the lawsuit is that when the initial offering was made back in 2015, the stock price was around $15 per share. They sold 42 million shares, and they allegedly misrepresented facts in their IPO offering that had people known they may not have invested. And so the idea is because of their misrepresentations, that we would seek our losses back.
Our loss threshold under the policy is $100,000. Our approximate loss with Pivotal, depending on the date that the suit claims, could vary in between $155,000 to $165,000.
Thank you. I remember now. Any questions, any additional questions on item 12C?
It's a pretty typical lead counsel agreement. I don't see any problems with it. The biggest impact would probably be on Paul and Renee, because part of the motion is to allow them to be your representatives. You may have to take their deposition. Paul has to sign a statement about the contents of the pleading that will be filed. And I've looked at all that, and I'm comfortable with all of it.
I just want to be clear on the retention agreement, 2A, it says recovery of costs is contingent upon a recovery being obtained. So we're not upfronting the cost?
No.
Okay, just wanting to clarify.
The law
Thank
firm
you.
is covering everything. They make money by being the lead counsel, so.
Still need a motion on 12C.
Move for approval.
Have a motion and a second on item 12C. All in favor? Aye. All opposed? Motion carries. Item 12D is to approve the updated consolidated ERS pay plan, consolidating ranges and steps to better reflect staff size and to be more comparable to the City of Oklahoma City pay plan structure.
Move for approval.
Any questions? Have a motion and a second. All in favor of item 12D? All opposed? Motion carries. Item 12C is to, E. I even got my glasses on. I can't read that. Accept the recommendations of the Administrative Oversight Committee and approve the placement of the Retirement System Manager at Step 13 of Grade 806 and placement of the Retirement System Analyst at Step 13 of Grade 802 of the updated/consolidated ERS pay plan, retroactive to February 11th, 2019, and/or enter into executive session to discuss.
I move for approval.
I have a motion and a second. Any questions? All in favor? Aye. All opposed? Motion carries. Item number 13 is Investment Consultant Report. Good morning.
Good morning. So this morning I have the quarterly report and the July ASAP. Before I get to that, just a couple of things I want to just mention about ACG. You may see next week an announcement about our Director of Research, Lori Mills. Many of you may have met Lori. She's been at the conference in the past and spoken at our educational sessions. She has been fortunate enough to be retained, hired as the Chief Investment Officer for one of our largest private families that had a very significant liquidity event. So it's the danger of doing very good work for people. So we're really happy for Lori. She's been with us for about 15 years. Now she's going to be one of our largest clients. Taking Lori's place as Director of Research will be Roger Willis, who some of you may have met. Roger's been with ACG for about 10 years. He came to us from A.G. Edwards Trust Company, where he was the Chief Investment Officer for A.G. Edwards Trust, so he has a background in managing research groups. He has been our chairman of our investment committee for the last 4 years and a senior consultant working with a number of our what we call RIA relationships, where he works with other advisors. So it should be pretty seamless. This role really is managing our research group. There won't be any change to our philosophy or approach or how we go about advising clients on issues. The other thing I want to mention, because I did get a question after a review of our ADV just about our ownership. ACG's ownership has not changed since you hired us in 2004. We have been a wholly owned subsidiary of Guggenheim Partners since 2001, and nothing has changed with respect to that. Just as a reminder, Guggenheim Partners is a diversified financial services company that has interests in a number of different entities, including ACG. Our management team continues to manage the firm and the P&L and the hiring and firing and everything we do. We have Chinese walls between us and the other asset management businesses, and so much so that we will not even consider any products or services offered by affiliates, and that has not changed. What they do provide is accounting, HR, some IT support, and some legal and compliance report. It's been a good relationship over the past 18 years and continues to be. So I just wanted to mention that because I did have a question regarding that. So, if you will, I'll turn, kind of go over both the quarterly report and the ASAP as we sit here today in some very volatile markets. And I know you had your actuary in last month, giving you a report that you just finished, your funded status just dropped down under 100%. I think it is important to recognize that markets are volatile. We have come through a very strong 10-year period. As you'll see in the quarter report on page 25 in the big book, your 10-year return through the end of June is just under 9.5% annualized, which is about 2.3% above your current actuarial required rate of return. So over this 10-year period, you've really been able to participate in the markets in that upside while managing volatility or risk. All of these other factors that we show on this page below that are 3 of the 5 primary total fund objectives are risk related, because that's really the one thing that you control is the risk in the portfolio. The direction of the market from month to month and year to year, we don't really have control over. Over time, we expect the markets to go up, but we know there's a lot of volatility in the short term.
Jason, I'm sorry. That rate of return you're talking about, is that net of fees?
That is gross. If you go back a little bit further to page page 30, Jim, we started calculating net of fee returns, I believe it was 5 years ago, because you pay your fees out of a different account. We weren't capturing that data, but I'd say it's probably about 60 basis points. So let's call it 880 on a net basis as a rough estimate. On page 30, you see the 5-year number there. The light blue bar, we show the net of fee return. It's 570 versus 630 gross. So it's about 60 basis points of fees. What we're using here is, on that page is a gross of fee number because we didn't have net of fee numbers. But I think ideally we would look at net of fees. And now we are capturing the net of fees. Historically, we showed gross for a couple of reasons. Primarily when comparing to peer groups, we did not have net of fee peer groups. Now we have net of fee peer groups. So that's why we start showing, or why we were able to capture the net of fee data and now compare to net of fee peer groups. So you'll see that on page 28, actually. Those are gross. I spoke too soon. We do have net of fee peer groups we're showing you and gross of fee peer groups here. But we can add the net of fee peer groups. That's why historically we've always shown gross, is because peer groups were. Right. But now we do have net of fee peer groups, so we started capturing net of fee data across the board. Your portfolio, and really if we looked at the gross or net comparisons, it's going to look comparable because you've done a very good job of pressing managers on fees. And I'll mention another concession we've just received. But if you look at page 28 in terms of where the portfolio ranks over the last number of years, the one-year return of 6%, a little bit below that policy index of 6.75 and below the median peer. As we'll look at the July ASAP, one of the things that you'll see, the primary driver in that dispersion of return over the last year has been within fixed income. Essentially, the fact that you have very little duration exposure in your fixed income portfolio compared to what we're using in the policy index, which is the aggregate benchmark, which has a lot of interest rate sensitivity because majority of that index is made up of U.S. Treasuries. As you know, those of you that have been on the board for some time, you hear me talking about this quite a bit. We've been in a very low interest rate environment for the last 10 years. As a long-term investor with long-term liabilities that needs a 7+% return, we have tried to do things in this portfolio to enhance the ability to achieve that 7+% return without taking on additional risk, without just simply taking on equity market risk. And one of the big things is really diversifying the fixed income portfolio and having a much more dynamic approach and many more drivers of return than interest rates within fixed income, namely credit, currency, foreign markets, and doing some non-traditional things within the PAMCO absolute return space. Over the last year, as I'm sure you are aware, we have seen Treasury yields plummet in the U.S. over concerns about trade war, slowing growth, and certainly accelerating over the last few months. Just to give you some perspective on that, on terms of relative returns of broad benchmarks, on a trailing one-year basis, the Barclays aggregate index, which is U.S. investment-grade bonds, is up just under 10%, 9.73% through yesterday. The S&P is up just under 3% on that one-year period, 2.95%. So bonds, best performing asset class on a trailing one-year basis by over 6%, almost 7%, which might surprise many of you, because if we look back a couple weeks ago, we were reaching new highs in the S&P, but really that's what we've seen. 10-year Treasury on a one-year basis is down 1.25% from a year ago. It's yesterday or this morning at 1.74%, down from around 3%. So we've had a big move down in Treasury yields, pushing bond prices up. We think bonds are pretty rich today, as we've seen this massive flight to quality. Small cap stocks on a trailing one-year basis are down negative almost 10%. International developed are down about 5%, emerging markets down 7%, and commodities down 9%. It's a pretty significant downdraft. Much of that was in the fourth quarter of 2018, and then we've gained a lot back year to date, but over the last month, you've started to see some erosion in those returns. So year to date, calendar year to date returns look a little bit different, but the last month has eroded that and really making the impact of the fourth quarter more impactful on those one-year numbers. So year to date, the S&P's still up 16% year to date, but that one-year number is 2.95. So you can see the impact of how bad that fourth quarter was, which I know you were asking about earlier. Small cap stocks are up 12% year to date through yesterday, but 1 year still down 9.8%. Fourth quarter alone, small cap stocks were down 20%. Big downdraft in small cap stocks, and that was the measurement point for the actuarial analysis, which impacted your funded status as you're looking at it at a point in time. Overall, just turning to those results, again, on a one-year basis in the 63rd percentile, 3, 5, and 10-year basis, the plan return ranks in the top third of the peer group, the public fund defined benefit peer group. So looks good relative to peers. More importantly, you're capturing that return with less risk, which is what we've built the portfolio to do. And just turning to the ASAP, if you will, the July report, in terms of the asset allocation, you're pretty close to targets, a little bit overweight to U.S. stocks within equities, as U.S. stocks have done better, particularly large cap, than other parts of the market, than emerging markets and other and international stocks. So you slightly overweight. We've been using that to raise capital to fund your operating needs and to rebalance a little. Fixed income, you're essentially at your target, about 19 basis points over. Do have an overweight to Core Plus, and that's been beneficial. Core Plus is the WAMCO, or the Western portfolio, so they have the ability to toggle between high yield and non-U.S. debt. I will say what they've done, that it is dynamic. They're not going to be constant overweights in those areas, and in periods like the current environment, they've brought down that plus exposure considerably. So they have more treasury and agency-backed mortgage exposure today, not taking on all of the credit risk that they have at times when spreads widen out that give them some ability to outperform. What has hurt within the bond space is the absolute return PAMCO strategy really just doesn't have interest rate sensitivity at all. So they're doing more relative value trades, which can be in some equity instruments, as well as distressed debt and other long-short credit-oriented investments. That, if we look at the second page and you see the fixed income composite, when we roll all of your fixed income up, which includes the State Street core bonds, the Western Core Plus, PAMCO, the judgments, and then Brandywine, your core bonds on a one-year basis are up a little over 5.3%, whereas the benchmark ag is up over 8%. So that's that dispersion. That's 25% of your portfolio underperforming what we're measuring against in the policy benchmark by about 2.5 to close to 3%. Big dispersion. That said, you're still getting plus 5% return, but that's where that difference is coming from. We don't feel the need to change that today. We still think we're in a similar environment of low to, over time, rising rates. You have exposure to interest rate or to duration. That's why we don't eliminate the SSGA bond fund, so you're getting the benefit of that. But your overall construct of your bond portfolio, that's why it lagged in this period. Real assets have performed well, up over 4% versus the benchmark at 1.8. Your small cap portfolio on a one-year basis done very well. in a period where small cap, as I mentioned, through yesterday is pretty significantly negative. Through the end of July, 87 basis point positive for the benchmark. Combination of Earnest and Times Square is up over 7.5%. Really getting good returns there. Times Square outperforming on the growth side. Your growth manager's done a little bit better. Growth has outperformed value pretty consistently over the last several years. That said, Earnest is a relative value manager that tends to have a little bit more growth characteristics. So in periods of time where growth is outperforming, they're not doing as bad as other value managers, and they've done a nice job. Your international managers have protected a bit. Both Lazard and Harding Loevner combined down about 1.25% on the 1 year versus the benchmark down 2%. Lazard's done a little bit better. On that note, we were just recently able to identify a new share class for Harding Loevner that you are eligible for. You're invested in their mutual fund. Moving from I think it's the new, I'm not sure what the share class is, but we've just done that. And it's going to save you about $22,000 a year in fees. So we're able to push that down. Just to continue to tally up the fee savings that you've received over the last about 18 months, much of that coming from long short, the transition from the K2 overseas fund to the K2 Mauna Kea platform. But also we've negotiated reduced fees with Times Square and SSGA. It's a fee, and coupled with now this Harding Loevner, it's about a little over $500,000 in fee savings that is ongoing from year to year from where you were. We're in the process of negotiating further fee reduction with Wasatch, and it's not happened yet, but we think that's going to happen as well. So it's something to keep in mind. I mean, we're not letting the fee tail wag the overall dog, if you will, but it's something that we want to continue to push on. As your portfolios grow, and as with these managers that we have a lot of clients with, we're going to continue to push on them on an annual basis to make sure that all of our clients are getting the most favorable fee available. Finally, just it's been some time since we've done some formal asset allocation. The last thing we did, spent a lot of time last year really talking about the long-short portfolio and changing from the fund of funds to the K2 Mauna Kea platform, which is complete. I think over the next, maybe at the next meeting or through the balance of the year, we revisit the asset allocation. There's a couple of things that we've been talking to clients about. One of them is revisiting commodities exposure. Commodities has been a pretty tough place since you've been there. This year, our capital market assumptions have changed pretty dramatically in commodities, the return assumption, because we've brought down our long-term inflation assumption, which is a key component of the commodities return assumption, and it's making commodities not as attractive as a strategic holding. So we want to look at that. Also, as you've grown, you've had a 5% target to private equity for some time, since you implemented private equity in 2009. And that's really where we would start plans like yourselves, because it takes time to build a private equity program. You're closing in on that 5% target today. Really, as a long-term investor with long-term liabilities, we think you have the ability to invest a little bit more in private equity. That's the benefit of private equity. It's a long-term asset class. You get a premium return for that illiquidity, perhaps looking at bumping that up a little bit to enhance the return over time. So I just mentioned these things. These aren't recommendations today. I want to come back with some formal asset allocation, because I think it's been probably 3 years since we've done a look at that. So probably at next meeting, depending on agenda items, we'll take a look at that. Any other questions?
Thank you for your work on the fees. I appreciate you keep
And
pushing on that.
I'll tell Patty that too, Patty Karolzak, who you know. She beats on the managers quite hard every year. She starts this process in June and really works it all summer. So, and we always see some benefit there. Thank you.
Thanks, Jason. Okay, item number 14 is comments from board, staff, and citizens. I just want to remind everybody, if you're planning on going to the Public Funds Trustee event, to make sure you get with Renee. We're a little bit more than a month out now? Yeah, so just a reminder. And hearing no questions or comments, we are adjourned at 10:32. Thank you.